Welcome to the September 16th, 2024 Advance Report for McGowan Group clients and NetWorthRadio.com listeners. This week, we're anticipating the Federal Reserve interest rate cuts. And I have an intelligence read for you on that subject for Wednesday afternoon this week. But there's a few money flows, huge money flows, that we want to look at in anticipation. One is the market rally. The Dow Jones Industrial Average up 11% for the year, S&P 500 up 19%, and the NASDAQ up 16%. Now, a couple of things I wanted to point out. You had the carry trade in Japan, where fancy hedge funds borrowed money in Japan really cheap, and the yen was going down, so they had to pay back less money. So they bought more Nvidia and other tech stocks with it, apparently, and you can see it right here. Bank of Japan says, hey, we're going to raise interest rates because we don't like the yen going down, and there was huge selling. You could see the NASDAQ really led that selling, and it started right at the end of July, or beginning of July, and really accelerated in early August. Now, in sympathy, of course, the S&P and the Dow had a big old sell-off. But remember, we're anticipating Federal Reserve interest rate cuts, and earnings are pretty good, as we've covered in previous segments right here. By the way, I'm Spencer McGowan, your financial weatherman, President, McGowan Group Wealth Management, a team of 11, the team that cares. We serve affluent families right here from the Crescent in Dallas. You can go to networthradio.com, contact us there for your updated plan. So get in touch with us at networthradio.com or potentially be a victim all your life. You want an updated plan for the next 10 years, and we'll be happy to do that for you. Now, here had a big old sell-off. It was delevering. Those things usually don't take long, but they're pretty severe. And one day the Dow's down 1,250 points. Well, anyway, and in our model portfolios, we looked at what to add. But here you've got the Dow almost at an all-time high. It's just 200 points from an all-time high. S&P is about 1% from its all-time high. The rally's broadened out, and tech stocks are still substantially, well, they're below what their peak was. So you've broadened out into other categories, and I'll show you a couple of those here in the next upcoming slides. Now, with this, what it tells you, yeah, the Federal Reserve, the wind is at your back. But how long is the Fed going to cut? If you're a subscriber, you know that we covered this back in March. The Fed said, we're going to cut rates for 3 years. Doesn't matter which meeting they start, which is likely this week, but the bond market's already telling you what they're going to do and how much. See, the bond market doesn't wait for the Fed. The Fed's leaky. All these guys play golf together with the big bankers, and look what's happened. All right, Federal Reserve, as of this recording, they're saying Fed funds rate, overnight bank lending rate is 5.25, 5.5. Therefore, 90-day T-bills are about 5.25, 5.5. You can see it back in October, 5.348, about exactly the midpoint, right? Because they dictate that rate. Now, the free market rate, 90-day T-bill, has actually, whoa, what happened here? It's below 4.8%. Well, we've dropped to 0.5%. What does that tell you about the potential Fed cut? The bond market is telling you it's likely to be 0.5% instead of 0.25. Well, if they did 1%, then it would scare everybody that they know something and there's a bad recession coming, whatever. So they're probably 0.5%, but their own projections show they're going to do this for the next 3 years and get down to 2.5%. That's where inflation is. I'll show you that in a second. But the 30-year Treasury's already gone down to 4. The 10-year Treasury's gone down to 3 2/3. It was 5% back in October. If you're looking at mortgage rates, you already had your first interest rate cut of over 1%. Wow. So the bond market's already moved, and that's because the Fed is leaky. Now, 2.5% CPI. by their own definition, that's where the Fed should be. If you want inflation under control, you put the Fed funds rate exactly where inflation is. That becomes the base rate. Well, trailing 12 months is 2.5. It peaked over 9%, and that everybody's budget got wrecked at that point. But it's getting better. You actually had food deflation. I'm going to cover that next week. But food deflation, 3.7% drop in August for online grocery prices. That's the biggest that it's had since it began tracking 10 years ago. That's food deflation. Why? Commodity prices. Corn's down 15% over the past year because there's a bumper crop. And similarly, you've got some of the base commodities, including soybeans, down over 20%. All right, here. These are job openings. There were 12,000 jobs, 12 million jobs back in March of 22. That number's come down consistently, 7.6 million jobs available. That's still a good number, and it happens to be about where we were in 2021 coming out of the pandemic. So that's less wage push inflation. Food deflation says the Fed could come down a lot faster. Now, what besides tech is making money? Well, I've got two examples here. This is year to date. One example, a pipeline fund, not a recommendation for your portfolio till you come down to get a plan, but we've been talking about pipelines since the wheels came off the go-kart in 2020. 18% year to date. Now, that's not without price risk because it got smashed in 2020. It was a really good buy then. But anyway, now, another one is global bonds. You're looking at a total return year to date. Pipeline's actually 22% with yield. You see these things actually yield. You get a cash dividend. Now, global bonds, a fund I've used for over 30 years. There's a time to be in it, there's a time to be out, and we do those in the model portfolio. It's up 15% year to date. Not everything goes up all the time. Not everything in the portfolio is up year to date. But the portfolios are doing fine, and these are two stellar examples that happen to be our number one and number two positions: energy infrastructure and global high yield. Thank you for tuning in. We'll have the episode next week, so be sure to subscribe. Thank you for tuning in today to Net Worth Media. We also have Apple Podcast. Simply type in Net Worth Radio and boom, it'll hit your phone right then. If you also go to networthradio.com on a browser, you're going to be able to meet the team. You can see our performance track record, the model portfolios that go with today's broadcast. Also at networthradio.com, the Longer Play podcast is available there as well. We're grateful that you've tuned in. Remember, when we talk about a security, it doesn't make it a recommendation for your portfolio until we actually complete a written plan for you by Zoom or in office or simply a conference call. So you reach us at networthradio.com if you want to get that arranged. Market fluctuations and how to handle them. We build high cash flow portfolios, and past performance doesn't guarantee future results, so you do have to be ready for challenging markets. We can build more cash flow during challenging markets than we can when everybody's happy and everything's up, which is when we tend to raise tactical safety. Those allocation strategies are here at networthradio.com. Thank you for tuning in.